Hello everyone and welcome back. In this video, I want to talk about two undervalued stocks to buy in 2026. I believe these are very good risk-reward opportunities, and I think if you buy them now, you have a very good chances of outperforming the market in 2026. So full disclosure, I'm a shareholder of both of these stocks, so obviously I will be biased, and the more I do some research, the more I like them. So actually the bullishness is increasing, which is the reason why I'm making this video. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I want to continue to make this 25% per year, which means if I buy these companies right now, you understand the kind of returns I expect. And the first company I want to talk about is Adobe. You all know Adobe. It is known for being a PDF company, for Photoshop and their complete ecosystem, but the stock is hated right now. On a 5-year stock performance, the stock is flat. The business has become cheap, and the worries people have are, for the moment, temporary. Right now, you have a lot of worries when it comes to Adobe. You have plenty of competitors. People are looking at Canvas, Affinity, Figma. People are looking at Gemini or Banana Pro or all the ways you can generate images, videos on ChatGPT, or all the software tools that are now available for free. And yeah, these threats are real. These threats are real, and for normal people, individuals, for people with a lower budget, it's true. You have more competition. If you want to use Canvas, you can do it for free. You can generate thumbnails completely for free. So if you are an individual and not a professional, it's true. But the truth is, Adobe is not focused on this kind of customer. Adobe is focused on the professional side, which means Adobe doesn't really care about Canvas or Figma or all the way you can generate videos on ChatGPT or Gemini. Adobe, for many years, has been focused on professionals. You want the ecosystem to be so powerful, so complex, that it's the best tool. And for the past few months, with all this new wave of AI software, you had a lot of people worrying about Adobe being disrupted. I think Adobe, for the first time in late 2025, Adobe has become more aggressive, and they are playing now offense, which means they want to integrate AI everywhere, delivering better products, better services, and they want the best editing software out there. And so far, it is working. So far, Adobe is having the best software. Yes, it's not for free, but it's the best. So if you are a professional editor, if you are a professional photographer or something like this, you want to use the best tools, right? You have a budget, you have a team, you have professional clients, you have some strict deadlines. Will you really switch to Canvas because it's cheaper? If you are a professional and you want the best tool, no, you stay with Adobe. And Adobe has been aggressive. They are delivering better products, better services. And the fundamentals of the business have decelerated for Adobe. If you look at the past, this is the revenue in blue. The revenue was growing, 20% per year. And now, since COVID, since 2021, 2022, the revenue is only growing 10% per year. Okay, I can show you what I mean actually. I can show you on Fiscal AI the revenue growth rate for the past 10 years. I can show you for the past 20 years actually. By the way, Fiscal AI is the best tool, so you can see this kind of charts. I have an affiliate link in my description. If you want to use Fiscal AI, it will get 15% cheaper for you. Anyway, for the past 10 years, the revenue has been growing at 20% per year. And now, since 2021, 2022, the revenue growth has only been 10% per year. So the business has decelerated. So the stock deserves a lower multiple. It's true. If you look at anything can work. The P ratio, the price to free cash flow, anything works. If you look at the revenue growth rate and the price to free cash flow in blue, it's normal to have a re-rating. The business is not growing as fast, so it's okay to not deserve a price to free cash flow of 37 and now deserves a little bit lower. But is it deserved to have a price to free cash flow of 15? For such a quality business with such an ecosystem, such a wide moat? My opinion is no. I don't think so. The stock is a little bit too cheap to ignore right now. The stock can continue to go lower. In reality, some people compare Adobe right now with Meta platforms in 2022. And Meta platforms at some point had a price to free cash flow of 9. So yeah, of course, it can go lower than 15. It can go to 13, 12, 11, 10. It's okay. But you never know, right? And you will never have perfect information in the stock market. You have to make decisions with incomplete information. And Adobe is the latest stock I have bought for my own portfolio. So you know what I think about Adobe right now. And I want to increase the exposure. I want to increase the position. As I'm recording this video, it should be 6, 7, a little bit more than this, 7% of my portfolio. So yeah, pretty decent size. And the latest quarter gave me conviction because they are re-accelerating their AI products, AI services. Okay, and the business is still not dying. The revenue is still growing 10% per year.
By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video.
What will happen in the future? Either the revenue growth rate stays at 10% per year, and the company will use all its cash to do buybacks. By the way, I can show you this. The revenue up and to the right, net income up and to the right. They don't have any debt problem. They are generating cash flows every year. And all the cash right now is used to do buybacks. They are repurchasing like 5 or 6% of their shares right now. So they are doing strong buybacks, especially since the new CFO joined in 2021. Okay? So right now, if the growth rate stays the same at 10% per year, they will use all the cash flows to do buybacks. So you grow 10% per year, you do 5% buybacks, which means your earnings per share can grow roughly 15% per year. So you have a business that can grow earnings per share at 15% per year, available at a price to free cash flow of 15. Looks like a deal to me. So this is the reason I'm buying Adobe. Right now, the stock is still hated. People like to compare this to Canvas. People like to compare this to Figma. People worry a lot about AI because video generation has been here for some quarters now, and people can already create videos for free on LLMs, ChatGPT, Gemini. And what will be the future in the next 3 years? Maybe you can do the complete editing of a short movie in ChatGPT, on Gemini. Now, in 1 or 2 years, the development of AI video generation has been great. What if the growth rate of improvement continues? You can create professional videos, edit professional videos, everything for free. Well, this is what people are forecasting. People are worried that this will be the future. Maybe it's true. I start to see some people editing videos on Gemini, on ChatGPT. It's not perfect for the moment, but maybe in the next 2 years it will be perfect. Would it happen or not? We have incomplete information. Be my guest. So Adobe is partnering up with ChatGPT. Adobe is partnering up with Google and Gemini to integrate Adobe inside their tools, inside ChatGPT, etc., etc. So Adobe wants to fight back, Adobe wants to be present, and Adobe is using a new form of monetization called the credits. Well, you have new formats, you have a Firefly, you have new ways of monetizing your AI audience, and apparently Adobe is fighting back hard. Now 1/3 of the business is AI driven. And my strong guess is for the next year, for the next 2 years, the percentage of AI solutions will grow from 30% to 40% to 50% to almost everything. This is what all the SaaS companies are saying right now. I'm including FactSet, I'm including Salesforce in this list. Plenty of companies that are hated right now are monetizing their user base with AI. And a lot of worries are here when it comes to reduction of seats. If Adobe becomes more efficient, maybe you will need fewer licenses. Same thing is true for FactSet. Same thing is true for MSCI. Same thing is true for all the analytics companies. Same thing is true for Salesforce. But for the moment, we don't see any signs of this. For the moment, customers are using this software, these tools, are using AI, and are using more of this software. So for the moment, we don't see a reduction in seats. Maybe the narrative will completely collapse. You have what is called the Jevons effect, which means people worry too much at the beginning of an innovation like this. And then because the cost of implementation is so low, more people will use Adobe. More people, small teams, small businesses will start to buy an Adobe license because the Adobe ecosystem is so strong. So a lot of uncertainties right now. And I want to go back to a quote from Monish Pabrai, which means you want maximum uncertainty and minimal risk. What is the difference between uncertainty and risk? Well, uncertainty is temporary. Uncertainty can be dealt with, and this is exactly what is happening with Adobe. Like many uncertainties, people worry about competition, people worry about the new wave of innovation for Adobe. And what is the risk? The risk is everybody leaves Adobe. The risk is professionals leave Adobe because the competition has become so great. This is not happening. Professionals stay with Adobe. If you're a professional, you don't have a budget issue. If you're a real professional, you want the best work. Will you work with Figma or Canvas? Will you really switch to competitors just for saving a little bit of a cost? I don't think so. I'm seeing a lot of videos on YouTube or anywhere actually, and professionals are sharing their story. They want to switch, they want to try another platform, DaVinci, etc. And at the end of the video, they say, it's great because it's cheaper, but I have created my whole career with Adobe. This is smooth, everything is flowing correctly. All my teammates, all my colleagues are using Adobe. You have this ecosystem with this format. It's much more easy to stay with Adobe's ecosystem. It's simple, it's more simple, more efficient, it works better, it's faster, it's more expensive, but it's better. So at the end of each YouTube video about a professional looking to switch, they say, yeah, it's great, Canvas, great, all the free tools are great, but it's much more efficient to use Adobe, much more efficient. And I believe, well, we will see if I'm right or wrong. I believe Adobe will become even more efficient because they will integrate AI everywhere. So the tools will be even faster right now. And actually, I'm seeing some signs already of all the AI implementation for 2025. And I suspect they will integrate AI much more in 2026. Actually, I have tracked the number of times the Adobe's management team has said AI in their earnings calls. And I suggest you do the same exercise at home. But it reminds me a lot of Google. All the bulls want the situation to look like Google a couple of months ago, actually. All the bears of Adobe say the same thing, say that Adobe is dead, Adobe has no moat, and that is getting killed by competition. And all the bullish people, all the bulls are saying the same thing. It's like Google is not being disrupted, professionals are staying within the ecosystem. Well, I'm definitely a bull right now, but I changed my mind. A couple of months ago, I was a bear. I was not convinced by Adobe because Adobe was playing defense. And now it seems like they're playing offense. They just had an acquisition of SEMrush. They just integrated this new monetization of AI everywhere. They just had this Adobe Max conference that was pretty compelling. And they just ramped up the monetization for AI. 6 months ago, we didn't have this. They were mentioning AI, but they were not monetizing it. And now, for the last quarter, actually, Adobe showed investors, showed the world how they will monetize AI with very high margins. Now, Adobe has what? 90% gross margins, 90% gross margins, net margin of 30%. I believe the margins can continue to go up because they are just generating royalties that are pure profits at the moment. Okay, so this is the first stock I wanted to talk about today that is a little bit misunderstood, hated. I know some people don't believe in the story. That's fine. This is why we have 50,000 stocks in the world. You can choose whatever you want. But I'm telling you, Adobe has good chances of rebounding. For some reason, when the stock is down, people hate on the CEO. The CEO has been here since 2007. And I'm listening to a lot of people, actually. I have read many stories about how the CEO is not the founder, so it's not good. Guys, Adobe was founded more than 40 years ago. The founders are all dead. They passed away a couple of years ago. Of course, the founders will no longer be here. So you have a new CEO, and some people say the CEO is somebody that joined recently, so maybe you don't have a lot of insider ownership, which is true. You don't have insider ownership for Adobe. You can look at this ownership. This is why I like Fiscal AI. You can just navigate everything. Here we go. The CEO owns 0.01% of the shares, so almost no insider ownership, nothing. So maybe he's not the guy who will make the change because of this new AI revolution. Okay. Well, to these people, I can reply that this is not the first massive change Adobe has seen. Because in 2012, Adobe had a huge change. They went from you buy a CD, you buy a package, you buy a suite office for Adobe, to now a subscription business model. At the time, people hated Adobe because they wanted to have to pirate the license and have it for free. And now you can no longer do this because of subscriptions. And then Adobe has increased their subscription prices. So people complained, blamed on the CEO. Well, look at the numbers. The numbers don't lie. If you look at the past for Adobe, before 2012, 13, 14, how can I show you? Creative Cloud, Digital Media. I want subscription revenue and product revenue. Look at this. In the past, look at this. 2012, the blue line is the product revenue. You buy Adobe products, Adobe software solutions for a couple of hundreds of dollars. And then they introduced the subscription business model. At the time, people didn't like the CEO at all. At the time, people said, who is this guy? No insider ownership. He's not the founder. He will ruin the company. He will destroy the company. You wait 1, 2, 3 years, and now the subscription-based revenues continue to go up. So it's not the first massive change that Adobe has lived through. It's the second for the CEO, actually. So to all these people that are saying the CEO is not the founder, no insider ownership, he will take no accountability, no responsibility, well, he actually made a massive move 10 years ago, and he succeeded. It's not the first time Adobe is transforming itself to a new era. So will they work? Will they implement AI and monetize AI? You will have an incomplete information. This is how you build conviction. Some people believe in the thesis. Some people don't agree at all. This is fine. I would gladly take the shares of all the bears. This is fine. I'm happy to buy more. Okay, so now about the valuation, I told you you had a price to free cash flow of 15. I created some custom metrics for Adobe. I can look at the EV to free cash flow if you exclude SBC. Even if you take into account the SBC, it's a SaaS company, so you have a lot of stock options. Look at the valuation ratio. You have now 18. We have the lowest valuation we've seen for the past 10 years. Adobe is hated for a good reason, and maybe Adobe is hated too much. So yeah, I'm buying a lot of shares right now, and actually I will monitor what is happening for 2026. If they continue to monetize AI, it will be a shame if they stop the monetization, if they slow down on the monetization. But from what I have read, they are accelerating. So what I want to monitor for 2026 is even more monetization tools for AI. I want them to reaccelerate the monetization. If they don't reaccelerate, it would be bad. But so far, so good. So this was the first stock that I believe now is undervalued. First stock I wanted to talk about on this video. The second stock is Meta Platforms. Meta Platforms is hated at the moment. People don't like the way it is being managed because of all the costs. So you all know Meta Platforms, right? You have Facebook, you have Instagram, you have WhatsApp, you have the VR headsets, and the stock right now, year to date as I'm recording this video, plus 10%. Not very happy with the performance, but we are talking about an extremely profitable business model with sky high margins. And now you have a lot of worries. A lot of worries because the company in the past was enjoying a lot of cash. Now they are net debt. And also the company is doing massive capex right now to build new data centers. They want to implement AI everywhere. They want to be more capital intensive. The only thing that matters right now, not that we know they are accelerating the capex, more investment, etc., is the capex reaccelerating the revenue? So far, it is the case. So far, it makes sense to invest a lot because the AI implementation is reaccelerating the business. The revenue growth rate was 26% for the latest quarter. You have a business, one of the biggest businesses on earth, growing at 26% per year. This is huge, so maybe you can let them have some costs. They are spending a lot of money, but they are growing a lot. So margins are trending down, but the top line is accelerating. It's an arbitrage, and I like this arbitrage. Now you have a lot of uncertainties. Will you be able to implement AI everywhere? Well, you already have some signs. You have more ads and more targeted ads for Meta Platforms. So far, the AI implementation is working. And Meta Platforms has a lot of flexibility. If for some reasons you have too much costs, they can cut some spending here and there. They just cut some spending for the metaverse, for the reality labs segment. So this is not the first time Meta Platforms is overshooting and then being flexible. I've been a shareholder of Meta Platforms since 2018. So yeah, I'm pretty confident in what I say. The management team is maybe the top 5 in the world. You have Mark Zuckerberg that controls everything, and you want Mark Zuckerberg to grow as much as possible. So he is doing a great job. He is monetizing all their tools actually, and you have a lot of software to monetize again. You can add more monetization on WhatsApp. You can add more monetization. You can ramp up the monetization on Threads. You can cut costs, you can cut capex if you want, you can cut spending on the reality labs again. You have plenty of ways to boost margins again. But so far, for the moment, Meta Platforms doesn't want to stop growing. So far, they are focused on growth. Let's not miss the wave, let's not miss the wagon and just invest a lot in AI as long as the music is loud. As the AI music is getting louder, people want to dance. Meta Platforms wants to dance, and the valuation is quite reasonable actually. Now the stock has dropped. We are, as I'm speaking, 16% below highs. And the PE ratio is what? 22? Forward PE ratio of 22 for one of the best businesses in the world, growing 26% year on year, sky high margins and a lot of flexibility, and an AI winner. That's it. That's the end of the pitch. Do you believe Mark Zuckerberg is competent enough to monetize AI? If you don't know this company, maybe you will have some doubts, but I've been following the company for more than a decade now, and I'm a daily user of all their platforms, so I understand very well how everything is working. And yeah, I can tell you they have plenty of ways to win in this battle. So I'm a shareholder of Meta Platforms. It should be 10% of my portfolio. So be careful with what I say. I'm biased, obviously. But yeah, I think these are two undervalued companies. If you buy right now, you have very good chances of outperforming the market.
If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.